Government sees their job as to steal. What they exist for is to take money from one constituency and deliver it to constituencies that vote for them. So the idea that the government will penalize the oil and gas business is true. But when the margin is there, they'll penalize the coal business, the gold business, or any other business.
Alrighty, Rick Rule. It's been a year, a very eventful year in markets. So we're excited to have you back on to pick your brain about what's hated, what's unloved, what people aren't talking about enough, and where the sort of opportunities are in the resource world. So let's start the conversation right there. What is the sort of part of the markets that you find most neglected at the moment?
I would say conventional oil and gas. It's a very, very good business. It's a business that, the big thinkers, Greta Thunberg and people like that, have suggested aren't going to exist in 2032 or whatever it is. When securities analysts do net present values on oil and gas companies, they tend to ignore the tail. They tend to believe that they aren't going to enjoy any cash flow after 2032, 2033. I'm pretty convinced that for the balance of your life, never mind mine, that oil and gas is going to be a pretty robust business. So if I had to put my finger on the biggest opportunity on a global basis, it's certainly oil and gas. I would suggest that even the biggest of the big and the best of the best, like ExxonMobil, are probably selling at a 50% discount to their net present value if you understand that those net present values are very long cash flow curves, and the net present value tail, is extremely fat. So that would probably be the one that attracts me the most. It's also a very good business. In the mining business, we all pray for return of capital employed, and the oil and gas guys talk about return on capital employed. It's a very, very different point of view. It's a better business. Not meaning to insult miners, of course, but you understand the point there.
I always find that fascinating, Rick, because Exxon, is the descendant of like Standard Oil, a company that started well over 150 years ago, and it goes through ebbs and flows of consolidation and separation. And recently we have seen a number of big deals and consolidation. So when you think about making that bet, do you think about, like you say, going for the Exxons of the world, or going down the curve and buyouts to come?
When I was a broker, I used to encourage clients who didn't have resource portfolios to buy market beta, to start their portfolios with the best of the best. And then after they had accomplished that, after they had accomplished starting a portfolio in an unloved sector, then I would take them down the quality trail, take more risk in hopes of greater reward. But what you learn in resource businesses is that when the sector returns to favor, just the beta, defining the beta as the extent to which that sector outperforms the broad market, is often incredible. And too often people have the strategy right, but they screw up the tactics. They buy some package of nothing nowhere juniors, thinking that because the gold price ran, those juniors are going to run, forgetting those juniors don't have any damn gold. And so when I constructed oil and gas portfolios for people, I would begin by buying the best of the best, by owning the beta, and not exposing the customer to any operational risk whatsoever. And then to the extent that the client exhibited some taste for volatility, some patience, and some willingness to learn, then we would take the client down the quality trail looking for more alpha. And that's still the same today. If I was constructing an oil portfolio today, I would start with Exxon.
And how do you think about the sort of evolving role in governments here? Because I totally hear the bet, but I can't help but think about what we saw in the coal industry here in Queensland recently, and for those unfamiliar, just a massive jacking up of the royalty rates after the fact, after the investments have been made. So does that perhaps tweak how you think about this bet jurisdictionally?
Yeah, but that's the same for all commodities. At the risk of sounding too American, and certainly this is a reflection on American politics, government sees their job as to steal. What they exist for is to take money from one constituency and deliver it to constituencies that vote for them. And so the idea that the government will penalize the oil and gas business is true. But when the margin is there, they'll penalize the coal business, the gold business, or any other business. Uh, their job, they would say, their job is to equalize or transfer wealth. I would suggest to you their job is to steal. You'll notice that governments aren't particularly a hindrance in a sector where the selling price of the product is below the cost of production. They're smart enough to know that you can't steal nothing. But when an industry starts to deliver the free cash flow that the Australian coal industry does, there was a famous American bank robber. I forget the guy's name, Willie Sutton, I think it was. And a guy said, well, so, Mr. Sutton, why do you rob banks? He said, well, because that's where the money is. And I think that's the way the governments think. They don't pay any attention to a sector until there's some low-hanging fat fruit that they can distribute to their constituents. And then, of course, they go to steal it.
We pray these periods of super profits in commodities where, you know, commodity prices randomly flex up for 1 year in every 10. And unfortunately, now that comes with the risk that you'll never have a super profit again.
And, you know, it's easy to steal from the coal business because
Yeah.
they're hated.
Oh, yeah.
You know, they do bad things. They put smoke in the air and all that kind of stuff. And listen, I'm all for reducing the amount of deleterious material piped into the air and pumped into the water and stuff. But here's a couple things that maybe the Australian politicians should reflect on. One, around the world, when people talk about carbon, emerging and frontier markets suggest that carbon quotas shouldn't be established nationally, but rather per capita. We don't like that in the West because we don't have too many capitas. The other thing they should suggest is that historical carbon loadings matter. And they believe that the big economies that contributed all the carbon pollution prior to 10 years ago should be penalized for that, which is to say Australian voters need to understand that if you're going to equalize the cost of carbon around the world on a per capita basis, Australians are going to really be punished for their past successes. The other side of the coal trade that makes me laugh is that people say it's a declining business. They say it's going the way of the dodo. The problem with that is that the biggest year on history for coal demand was 2024. It's set to be eclipsed in 2025. So those people are ignoring math. The government wasn't, of course. They decided to steal where the money was. But the other thing is people say, well, the future is what you have to look at. The future is alternative energy. I think I noted once talking to you guys a year or 2 years ago, and these are slightly old statistics, but humankind has spent about $5 trillion now on alternative energies. And we've reduced the energy market share of fossil fuels from a high of 83% 40 years ago to a low of 81% today. A $5 trillion investment has reduced the market share of fossil fuels by 2% in 40 years. That's an inconvenient truth for certain people, not, by the way, for the politicians who've decided to steal money from the Queensland coal shareholders. I'm afraid that cash cow will enrich them for years to come. But others need to consider that.
Yeah. I mean, the flip side of that one as well is that total energy demand around the world keeps growing. So
Correct.
whilst just 2%, the pie gets bigger and bigger there. While we're on the topic of government and specifically the US government, as we touched on earlier, I can't help but ask about the recent actions in the rare earths world. I think this is pretty monumental news that we've seen come out of the States, and it's going to be replicated here in Australia and I suspect in other parts of the world as well. How did you kind of digest that all to start with, Rick?
Rick's talking about rare earths. Now, there's a a rare earth deposit in Malawi that is literally going to come into construction now as a result of the entire dynamic being underwritten by Iluka and the Australian government recently. That deposit, Kakangunde, I think it is, Malawi, delegates from there, and Lindian, the operator of that project, all going to be at Africa Down Under,
So
mate.
you're going to want to get up to speed on Africa Down Under, which is kicking off next week, September 3rd to September 5th.
In fact, we're going to be there this time next week.
We are.
We're going to be there. Come join us. Tickets are in the show notes. Here, Dom, tell you all about it right now.
You know, we hear a lot of misconceptions and opinions about Africa, a lot of the time from people who don't actually ever travel to Africa. So it's, you know, it literally is straight from the source in this regard. So Malawi, for instance, we can hear from the minister there about how they're trying to establish a mining industry. We have the deputy minister from South Africa, you know, such a complicated, convoluted history of mining, but they are really trying to redraw the script there. So it'll be interesting to hear from her. The Ghanaian minister, Ghana's been in the news a lot recently with a few battles over goldfields and a few other things. We'll be able to hear from him firsthand what their approach is to new foreign investment. And then other exciting ones that we haven't heard a lot about. Egypt, you know, AngloGold have just paid $2 billion for the Sakari mine. It's the only mine in Egypt, huge 450,000 ounce producer. But they've never really seen a lot of foreign investment other than that, not even exploration. So the Egyptian minister's coming, which, you know, he's coming to Western Australia to try and court new investors and find explorers and establish companies to come and invest in their country. So, you know, you can get a real inside running, whether you're looking to pick up projects there yourself or, you know, buy equities in these emerging companies who are prepared to take that high risk approach. Then you're going to get the inside track on which countries are serious about attracting investment and which are perhaps not so serious.
Got to get your tickets.
Well, as a citizen, as a taxpayer, I think it's disgusting. As a speculator, I guess it's my job, if they're going to steal from me, to steal some back. I know not so much in the rare earths, because the United States, other than Mountain Pass, which isn't really a mine, in the uranium business in the United States, I went from being absolutely reviled 5 years ago, from being somebody who speculated in Hiroshima, Nagasaki, and 3 Mile Island, to now these morons want to subsidize me. And I have to say, I felt cleaner when I was reviled. I think what you say is true. I think industrial policy in the West has become afraid enough, particularly the Chinese and the threat by the Chinese to weaponize access to rare earths, that they will spend an awful lot of money to establish a China secure supply chain. And I think what you see in rare earths, you're going to see in a lot of different places. I think it's unfortunate, personally. I want no government nexus in any part of my life, but in particular in my wallet. But given that it's going to occur, I'm sort of duty bound to take the money.
Mm. And like, how do you think more broadly about that anti-China or kind of independence supply lines? Because, like you say, it's not just rare earths. It's going to happen in every single. I mean, we're speaking about it in copper as well, with projects and tariffs as these sorts of things. So, are there other sort of thoughts that come to mind apart from the sheer concern of the government plundering money there?
As you can gather from my earlier response, I'm not much of a politician. I don't know much about politics, but I've done a lot of business in China, and I would prefer a circumstance where we were cooperative with them. My experience in China has been largely good. I'm not trying to say it's been all good, but there's no place on the planet where my experience has been largely good. My preference would be, although we know we're going to compete with each other, that we understand that we need to cooperate too and find avenues of cooperation. That's probably not very popular with jingoistic voters who would, prefer to have someone of a different hue that they could hate. By the way, on both sides of the Pacific, the Chinese themselves are not short of jingoistic morons. Despite my preference, what the Chinese are doing today, which is to say, utilizing their economic surplus, unanimity of purpose, foreign policy to secure their supply chains, is exactly what the US did in the 1950s and 1960s. It's exactly what Europe did in the 1970s, what Japan did in the 1980s. We in the United States resent the fact that we have a competitor. We have a competitor that seems to be more predisposed to education, more predisposed to savings, less predisposed to whatever it is that America's predisposed to. So it makes perfect sense to me that we're getting outcompeted.
On that point, Rick, to tie it back to the rare earths in particular, I think 12 months ago you said that the easy money in uranium had already been made. Has the easy money in rare earths already been made?
I don't think so. For the simple reason that in the uranium side, we had a fair number of reasonably good deposits that were delineated as far back as pre-Fukushima. And you could see a deposit. Well, Boss is a great example. You could see a deposit that had been delineated, that you understood the path to prosperity. But before they had a chance to have a problem, the stock was up by 500 or 600%. Uranium, the easy money for me, and by the way, I think the big money is likely ahead of us, but we can talk about that later. The easy money is when the sector passed from being hated to being tolerated. As recently as a year ago, you'd go online and these people who had been ridiculous bulls on uranium 4 or 5 years ago, people who had uranium as part of their internet handle, were bemoaning the day that they ever learned to spell uranium. And we're beginning to tout, some crypto or something like that. The hate that uranium encountered as a consequence of the stupidity of the speculators who were commentating was unbelievable. And it occurred to me that all uranium had to do was become unhated. And that's what happened.
And your point on the big money there, how do you see that playing out?
Oh, listen, that's really exciting. Well, no, it isn't exciting. It's exciting to people who think and invest. Not to the rhetoric type. The structure of the uranium market is changing, and it's changing a lot. Right now, uranium is the only commodity in the world where producers and consumers can sign contracts of 5 years duration, 10 years duration, 15 years duration that specify price and volume. What that means is that if you're a uranium developer, you can know with some certainty how much uranium you're going to sell and who you're going to sell it to and for how much. And to the extent that you are a uranium junior who had no hope of financing your deposit and production, you had to sell it, and you had to sell it to a fairly narrow range of buyers. Now, you can do two things. You can sign a fixed price contract to build the mine with Westinghouse, Cameco, and you can sell contracts so that you can specify the price and volume 15 years out with investment grade counterparties, Tokyo Electric Power, China General Nuclear, Southern companies. There is no other resource sector on the planet that has certainty as to price and terms over time with credit grade counterparties. Mercifully, for this, quiet old lender, Rick Rule, or quiet old speculator, Rick Rule, not one investor in 1,000 has cared about the implications of price and volume certainty over time. It's interesting, this slavish focus on the spot market. Most days, the Sprott Physical Uranium Trust does more dollar volume than the spot uranium market is. The Sprott market has become the spot market. The tail is truly wagging the dog. And the volumes are ridiculously low, but people pay attention to it because it's an easy to grasp or easy to obtain data point. Useless, except to sell newsletters or get speculative pulses going. It really isn't an indication of the market, which its volatility will tell you, and its volume will tell you if nothing else does. But speculators pay slavish attention to it, a factoid sort of.
So what you're talking about with the price and volume certainty is effectively like an infrastructure akin funding dynamic that can transform the capital flow into the sector.
Yeah, exactly. As a lender, uranium is the only the only commodity on the planet where, if the contracts are set up, the lender knows the volume of material that can be sold and the price it will be sold for. In every commodity-based construction loan I've ever made in my life, and I've made billions, I've done it with my fingers crossed, because I had no earthly idea 2 years from now what the selling price of the commodity would be, or who my miner or oil company would sell it to. There is a startling degree of certainty around price and volume in the uranium business that, if the terms are disclosed to the lenders, should give the lender a lot of comfort relative to other businesses, and should ultimately reduce the cost of capital to particularly below investment grade uranium developers. I would suspect that the certainty too over the next 5 years will be comfortable to securities analysts. If you're a lazy old securities analyst, say Rick Rule, and you're trying to do a net present value calculation on a uranium developer, but you don't know how much they can sell her for what price. That discounted net present value analysis becomes voodoo. It turns out over the last 50 years, most of what I've done has been voodoo. And the idea that it becomes less voodoo is very attractive to me.
You know who's a very big Rick Rule fan? He told me.
Tell me.
Joel. So we've been talking about Jason O'Rourke, who COO at Axis Mineral Services, can crush rocks. But Joel, CEO there, mate, he'll hate the fact I'm talking about him. Shout out, Joel. I know he's a big Rick Rule fan. He'll be listening to this one. So we've got to put Joel next to Rick Rule.
We do.
And talk about the people
Axis Mineral Services.
What do they do, mate?
Mate, they crush big rocks into small rocks. That's the one thing you've just got to get into your mind out there. If you need to crush big rocks into small ones, Axis Mineral Services are the company. They have the track record as well, Trav. I know you know this. They've worked with all the top caliber mining operations in the goldfields, and they're expanding.
They do crush big rocks into little rocks. They've got an ability to sort out small rocks from each other.
Sorting.
They can now actually give you an entire front end of your circuit, the plant, on a BOO model. Mate, if there's a problem like your rocks are too hard, well, guess what? They can bring in dynamic, innovative solutions. Like, nothing is too foreign for these guys. I'm even talking about like HPGR. Like, that's a possibility, all thanks to the fact that Axis Mineral Services, they've now got this enhanced capability. They're part of the Rawbex construction group. And what does that mean? Things are possible that have never been done before.
They've got engineering firepower, financial firepower, and they have a team that just gets it done. Can't understate this one enough, mate. All you have to do is bring your problem to them, and they will serve the solution to you on a platter.
Mate, have you seen the team buy-in they've got? So they put up a little snippet of money of mine, and there were like 8 people that all shared that.
Just
Now,
like
that is buy-in. That's a team
buy-in.
with camaraderie that has real buy-in to this business.
That's a team you'd want to hire for a job.
You know what? So get in touch with Axis Mineral Services.
Go Axis. There's a couple added details that make it all quite interesting. So firstly, a lot of these restart projects that we speak about, you mentioned Boss, Paladin, another one that comes to mind, have seen sort of numerous stumbles in getting to that nameplate number. And then there seems to be a real apprehension in the market from the investor perspective to sign up to that price guarantee, because that's apparently locking away the magical upside. We see it more in the gold market, where there's this massive trend to be an unhedged gold miner now.
Investors want the volatility, mate. You don't take that away
They're
from
there
them.
for the commodity. So how do you take on board those two sort of notes?
You know what? I'm an old man. You can have some of my upside if you take away my downside. I'm really good with that print.
Oh no, these uranium companies will still give you downside. I promise you that.
I mean, we pick on uranium companies not attaining nameplate capacity. I've been around the gold business for 50 years. And to be honest with you, it's much more frequent than not. When guys announce economic completion, you'll notice it often isn't 2 or 3 quarters until the operation shakes in and they reach nameplate capacity. It seems that economic completion and nameplate capacity are very different things.
Oh, my favorite is when they announce commercial production, but it never made money, and then it goes broke. Yeah, what was commercial? Like you had a day where it made money?
Right.
Like I don't know.
So I take what you say about the uranium industry. There's a relatively small number of data points, but I suspect that what you talk about is ubiquitous, and frankly, not just in mining. If the three of us started a carpet mill, we had some big building, and in the front comes wool and cotton and oil or whatever goes into a carpet. What comes out the back to begin with isn't carpet. It takes a while to shake these big plants in, irrespective of what they're making. Sadly.
It brings me to another kind of question as well. Thinking about getting these mines online, Rick, you're in the loan making world as well. How do you think about the dearth of natural resource institutions, funds specifically set up to invest? We see it here in Australia. There's less and less of them. How do you think about that and what that does to future demand and supply?
Well, as a check writer, I think it's a wonderful thing. The idea that I have fewer competitors, especially young, smart ones, seems to me to be a very good thing. For the industry, of course, it's not a good thing. In truth, I think the biggest challenge the industry faces, other than rapacious governments, is the dearth of young people coming into the sector. I look at the mining industry, and it isn't just because of my age, but the people I see, it's very much like I'm looking in the mirror, old, fat, bald, white guys. We've been there for 50 years. We have experience, but we don't have legs anymore. And we, meaning the mining industry, we're not going to be able to fill the skills gap. We're not going to be able to fill it at the rock face. We're not going to be able to fill it in the mill. We're not going to be able to fill it in the boardroom. That's going to be a challenge for us. It will take care of itself over time. Markets always work. And if you have a shortage of people, what you have to do for a while, like we had to do in the early part of the 1970s, when mercifully I came into the market, is you have to pay those people too much, which is a good circumstance. That's how we cured the shortage in the early part of the decade of the 70s. And it's how we'll do it again. But it's going to be a challenge.
One of the other market-based iterations we've seen on that financing front is the move towards streaming, as well as royalties becoming ever kind of bigger. What do you make of this kind of presence, and do you think there's a natural bound that we get close to hitting upon there?
No, I think it's strangely rational. I think that the speculators in particular, the investors too, are willing to pay more for precious metals cash flow isolated in a royalty or stream. What that means is that when I'm competing with Randy Smallwood over at Wheaton and I'm a lender, he knows that cash flow to him is going to be valued at 16 or 17 times cash flow. If I'm looking for a 15% internal rate of return as a lender, he's going to beat me all day long. As he should. He's a lower cost provider of capital because the capital markets will give it to him. Particularly cash flow that comes from a lead zinc operation, silver cash flow that comes from a lead zinc operation, or gold cash flow that comes from a copper operation. The equities markets will give that cash flow in a copper wrapper 6 times cash flow, whereas they'll give it 15 or 16 times cash flow in a streaming wrapper. And a lot of people have said to me that they think that the big streaming deals are over, that the big royalty deals are over. I heard that at my conference in Boca Raton. And that's hokum. Uh, the copper business in particular probably in 10 years faces between 100 and $150 billion in front-end capital expense. And to the extent that they can sell the gold silver byproduct cash flow from that copper production at some number like 14 or 15 times cash flow, and use that to obviate more equity when they're selling at fairly low multiples of cash flow themselves, or premium price debt, they'd be well advised to do that. The second thing that's happening is that a lot of host governments in frontier markets would like to own larger pieces of their resource industry, politically palatable, all that kind of stuff, but they don't have any money. And they're constrained by arbitration agreements from stealing it, so they have to buy it. Buying something when you don't have any money is a bit of a challenge. And what I suspect is going to happen is that those companies will jawbone with the companies, those countries, pardon me, will jawbone with the companies, and they will finance the company's take by selling a stream. I believe that we haven't seen the biggest streaming or the biggest royalty deals that we're going to see. I believe that the next 10 years, we'll see literally multi-billion-dollar streaming deals and perhaps royalty deals. Increasingly, host governments are receiving royalties, some of them extraordinarily generous, on gold production, but somehow managing to squander all the money. Old money all gone, send new money. And I suspect that one of the ways that they will get new money is that they'll sell those royalties to the royalty companies. So I believe that the next 10 years for the royalty and streaming business will be even better than the last 20 have been, which have been pretty good.
So take for example, Panama. Who I think Panama has a phenomenal royalty over Cobra Panama, and you suspect that like it's not beyond the realm of possibility that the country Panama will sell their royalty over that asset to the likes of Franco.
Yeah, part of the royalty. One way that they might reach a fiscal agreement with Panama, who wants more money, is to give Panama some upside on the gold price or the copper price. That's called a stream. And Panama then can turn that into cash. Understand that the president of Panama, despite whatever pretenses he might have, doesn't care very much what happens to the government till after he's out of office. He wants to spend money now. So the construction of a 20-year stream and then the monetization of the stream in this guy's term is extremely attractive to him. And as a consequence, I think will resolve a lot of problems.
Watching that one closely, yeah, and I suppose like First Quantum, they've utilized streaming in a more forthcoming way than most miners out there. Most recently in relation to their Zambian copper assets, where they were pretty advanced, I believe, to sell down a minority stake to either Minara or Japanese trading house. Neither of those eventuated, but they've opted for streaming instead.
I can tell you with certainty that every big mining company in the world, particularly in the copper business, is looking at streaming transactions to finance construction. There are no exceptions.
That they might have an added competitor with the trend of gold companies coming in and looking at copper assets as well. Do you think that gets larger and larger with these big gold names looking at copper assets individually or copper companies for takeovers?
I think that'll depend on how Barrick manages Reko Diq. Barrick has done better in the market of late simply because their gold margins have been increasing. But the market doesn't like, I don't think, Barrick migrating to the copper business. I've always been sort of Catholic myself as to where my cash flow comes from. My apologies to Catholics. To me, cash is cash, and I'd take it from sand and gravel. But I suspect that gold companies that are perceived as being too copper dependent will suffer a lower cash flow multiple. But time will tell. If Barrick makes a huge success of Reko Diq, if the market accepts that cash flow, should it occur at a reasonable multiple, I think that's probably a good avenue of growth for the gold mining companies. They need to be careful because traditionally the copper miners have been much more efficient miners. I think it would be probably easier for a copper miner to come and operate successfully in the gold space than vice versa. The copper miners have had a higher cost of capital than the gold miners have for a long time. They've had even more price volatility than the gold miners have had for a very long time. They're pretty good miners in comparison. Maybe not good miners, as an example, compared to Agnico Eagle, but they're pretty good miners. And I think the gold companies might find that to be a hugely competitive league, should they choose to go down that route.
Should they choose to go down that route, or should the cash flow at Reko Diq occur? How are you thinking about the potential that a Barrick breakup could pan out over the next couple of years, like a Nevada
I think it'd
gold
probably
mine?
be a good thing.
Yeah,
But I mean, there was a time 40 years ago when Bristow listened to me. That was a long time ago. He hasn't needed a check from Rick for 4 decades. So,
Well, he's finally signaled that his departure is coming in a couple of years. They've started a search for a replacement, and the company famously doesn't have an obvious next Bristow.
Yep. I mean, there's something to be said for keeping the company together in the sense that size itself increasingly is a determinant of trading volume and share price, and hence cost of capital. On the other hand, if the capital markets can show Bristow or show Bristow's successor that the value of the sum of the parts is substantially greater than the price of the whole, then the board has to listen because it is a cost of capital game. Barrick certainly gets penalized, as an example, for their West African assets, despite the success of those assets. And they seem to attract a premium price for the Northern Nevada assets, despite the failure of the Northern Nevada assets for several years to make their AISC targets. So, I mean, perhaps a breakup is in the cards. I don't know.
Evolution's Jake Klein down here in Australia, Rick, sort of said a while ago that 8 feels like a natural number of assets for a mining company to have, or an upper limit of assets for a mining company to have. What do you kind of think of that, and with in mind that Barrick holds a bit more than that?
I think it's less important than the quality of the mines. I like what Newmont did finally. Newmont grew for size sake, and they grew and they grew and they grew, and they grew taking over agglomerations of tier 2 mines. I'm not saying they were small, shitty mines, but they weren't great mines. And what Newmont did after they bought Newcrest is they really cleaned house. I don't know how many mines they sold, 11 or 12. And they were probably mines that could benefit from the care and attention that they would get from a management team who was focused on that one mine. What it allowed Newmont to do was focus their attention on the mines that mattered. The 5 million ounce deposits, the 10 million ounce deposits, the deposits that were making 400, 500,000 ounces. So I think it's less important the number of mines that somebody operates than the quality of the mines they operate. And in particular, the concentration. I'm an old guy now, I'm old and fat and lazy, but I would hate to be a CEO and a COO or a COO and have to fly to visit mines on 4 continents. I wouldn't like that. I interviewed Amar Al-Jundi, who is the CEO of Agnico Eagle, at my conference a month ago, and was talking to him about the reason for the absolute and relative success of Agnico Eagle. And he said, really, we're a really good construction company, and a pretty good allocator of capital. But we try to operate in areas where we have an infrastructure advantage over our peers. it's not that hard to figure out. There were other things he said, their corporate culture, where he believes they treat their people better, and as a consequence of that, his turnover is a third of what other mining companies were. But an important thing that he said is that they don't seek to be all things to all people, that they are looking for centers of critical mass. And if over time they don't develop the critical mass, they sell the assets there, go back to doing what they do. And I think that's an important statement. I don't think that there's a numerically correct number of operations that somebody can operate. I think operating synergies matter, and I think size, scale, and durable competitive advantage matters.
Yeah, the rumor mill is always full of what is Agnico buying in Australia, for example, and of course they do talk about the fact that Western Australia has the geology that is one of the best geologies. But I'll constantly be skeptical that they're going to come here in the next 5 years, because they don't have an infrastructure advantage here. They'd have to acquire an infrastructure advantage here, and I think they've done enough work to realize that it's much more complex and higher cost, and the infrastructure's it's not quite the advantage that they think it is here.
Right now they define, or at least Amar defined, competitive advantage to me as construction and operation in cold, remote sites. That doesn't seem to describe Western Australia to me.
No.
The last time I looked, y'all had a shortage of glaciers.
Oh, I got a bluff, Noel. You'll find some snow sometimes.
A real shortage. On the thinking about construction and kind of gets me thinking about engineering and all these other parts of the mining business. Can't help but note, Rick, a lot of your investments are tied up in like mining adjacent type businesses as well. So obviously, in Sprott, there's a big sort of shareholding. So these picks and shovels ways of playing the market are pretty fascinating, and we've seen like in the last month in particular, the mining services business here in Australia have just skyrocketed. They've
multiple expansion is the only way you can explain it. Substantial multiple expansion. Substantial
multiple expansion, exactly. And yeah, I mean, I'm curious just to pick into this with you, because it's a trend you play in a slightly different way, tacking on to a potential bull market in commodities via a picks and shovel type approach.
I understand two businesses only. One is natural resources, fairly broadly defined: mining, oil and gas, agriculture, and forestry. I understand fisheries enough to avoid it. I'm no good at it. And I understand conventional financial services. And so the intersection of financial public services, a wealth manager, an asset manager, an insurance company, a bank, that services the mining of the oil and gas industry, suits me perfectly. I understand their underwriting criterion. I understand how they think, because that's what I've done for 50 years. I've been a fairly unsuccessful mining services investor. I've been a successful oil and gas services investor only because it's such a good business that it was tough to screw it up. You buy somebody with a durable technological advantage like Schlumberger in a business that doesn't go away, and they do well. But to be honest with you, the temptations that I've had, and they've been many over 50 years, to involve myself in physical picks and shovels as it relate to mining, I'd be embarrassed to show you the results. The companies that you talk about, like Sprott, which is to say offering financial services to miners, that's been a very different story. I've done well there. I compete with those guys. When, if I was going to look at a quarter for Macquarie, I'd know what I was looking at, because I've borrowed to them. I've been in syndicates. I've competed with them. I've bought them beer. I've almost thrown beer at them. So I have the ability to understand what they do, and that has been, I think, responsible for my comfort in financial services related to mining.
There's not a third type of business you understand well too, Rick, being media businesses?
No, I'm just learning that. I started Rural Investment Media with no idea how I was going to monetize it, to be honest with you. Sort of ready, fire, aim. And mercifully, my customers told me how to monetize it. I found, by the way, rich people are very generous with information as to how you can service them better. Uh, the success in rural investment media has been evolutionary, but I have a lot to learn in that business. Having fun learning it. I've got a great team.
Yeah. Well, I asked the question kind of tongue in cheek, but genuinely, how important is the media business to the deal access that you get in the investment space?
Not really. I think it's going to become increasingly important. What happened to me is I forgot to die. I lived a long time, and the people that I grew up with, the people that I was a pup with, turned out to be, movers and shakers. And so I got included in deals because I had checks that cashed, and for old time's sake. Unfortunately for me, the guys I grew up with are either dead or like Pierre Lassonde, increasingly long of tooth. So keeping myself relevant with 100,000 subscribers is probably my next line of defense.
To touch back on the Sprott investment, because that's one you've held for some time. Do you think it's understated, an understated way of playing a natural resource boom? The ways in which they can make money off the back of growth in commodities through the various products. And there's similar type ways you can play that here in Australia as well, is sort of notable in its size in your portfolio, it kind of seems.
I think it's safer and it's capital light, which is attractive. It's also, of course, a business I understand. The margins in that business are very, very high. There's a plethora of low fee products, in particular the physical trusts in that business, 35 or 40 basis point products. But they're 35 or 40 basis point products where there's very little effort required to run them. So your gross is your net. If you think about 40 basis points on $35 billion, it ends up being a very large sum. And it's highly leveraged to higher AUM. The higher AUM occurs two different ways. Organically, as the gold price goes up, more people are attracted to gold-oriented investments, and the value of the gold owned by Sprott itself goes up, so the management fee goes up. At the same time, that the multiple accorded to that cash flow goes up. I would be surprised, frankly, if 4 years from now or 5 years from now, Sprott didn't manage $100 billion. And I think they could manage $100 billion in passive products with effectively the same overhead as they pay today. And that would be very attractive for shareholders. At that point in time, I suspect 100 billion AUM, somebody like, Credit Suisse or Manulife or BlackRock, somebody who was trying to build a natural resource expertise and failing because they were 20 years late, would just say, you know what, I'll have that Sprott thing. That's sort of the way I think it ends. I think they get to 100 billion AUM, they become globally relevant, and then I think we enjoy a bittersweet exit.
Fascinating sort of way that could play out, and we've sort of seen very sort of small steps to similar type actions in the local sort of brokerage market down here.
Yep.
I want to change tack now, Rick, and run through a bunch of commodities, and the top of that list is lithium, and why that's top of the list, even though we've spoken about it a fair bit lately, is that you said a year ago that perhaps it'll take 2 years. And lithium will be a 4-letter word. It'll be, completely bombed out and hated. And the last year has been pretty rough, but it seems we've seen a kick up in prices recently. Do you think this is temporary and there's more hate to sort of come, or how do you see it playing out from here?
I do. I think there's more hate to come. When we talked about it last year, I'm glad you brought that up. That was unusually prescient. I thought you were going to bring up something stupid that I said. I'm delighted that you You managed to dredge out something smart.
I don't think you said anything
Uh,
stupid. It was all clever.
There's a few.
Wonders never cease. You'll recall the lithium boom. There wasn't a shortage of elemental lithium. There was a shortage of processing capacity. And it was a critical component of these lithium-ion batteries, so the price spiked. People started looking for lithium, and we found a lot. We hadn't found it before because we weren't looking for it. We had plenty, so we found a lot. And investor expectations were extremely high. We probably found 150 deposits. I don't know how many deposits. Maybe 6 or 7 of those go to production. So the shakeout, where you take the 150 aspirants down to, let's be generous, 10 that succeed, is going to piss a lot of people off. They aren't going to like it. They don't like it so far, but they ain't seen nothing yet. And I think on top of that, I'm no technology guy, but I note Chevron, Occidental, Berkshire Hathaway, all investing fairly heavily in direct lithium extraction from brines. I'm not smart enough to know if they make that work. But if they make it work, then things get truly ugly. I think I said a year ago, I was brought up in both the oil and gas and the geothermal business. And I always thought of lithium as a waste element or as something that you could use in small doses to calm your nerves because it was a waste element. It fouled your equipment. When lithium is really, truly hated, then I think there'll be good opportunities there, because I think you'll be able to pick up companies that have $1 billion into a deposit that have 100 million market caps. And that's always a pleasant circumstance.
There's one commodity that I think is in the hated bucket. I'm toying. I've never had exposure to it before, but I'm flirting with it. Vanadium.
I'm attracted to vanadium. Thus far, my attraction has been very painful. I was I got attracted to the vanadium market 5 or 6 years ago when most people couldn't spell it. And the consequence of that, I concentrated my bet on something called Largo, which originated a physical vanadium product, which didn't work. And the consequence of my genius is I'm down sort of 60%.
Yeah. They just did a
not
$6
including
million
the value of money.
They just did a $6 million secured loan on the physical product. But it's funky, but you kind of like, you look at it and you think either the prices need to turn in the next 6 months because that's when they got to repay it, or
No, I think vanadium's a good idea. I think you need to be patient. I think it's going to be extremely volatile. And there's a lot of applications for lithium, the vanadium redox battery being a new application, but the old applications use a lot of volume, and they have very, very, very high value. Making steel stronger is a good thing. So you're probably onto something. It's a very small market, and the people who participate in the lithium market need to be as patient as me, which is rare, and they need to be very tolerant of volatility. The other thing I would caution is that many vanadium mines that have grade don't have size. And you can be sort of right if you get a small mine and still not make any money. That's really hard on you. You get everything right except for the mine and you still lose money.
Yeah, you talk about that phenomenon where, like, as a taxpayer you're filthy, but as a speculator you see opportunity, and I have a suspicion vanadium's going to fall into that category, and we'll see something stupid from government that underwrites the cost of capital.
I think you're right. Yep. I mean, there's no doubt it's a critical metal. I haven't seen very many fields of human endeavor where government participation ever caused any net good. I wonder why mining would break that train.
Another commodity that has seen substantial government rulings change its sort of structure is nickel. We've touched on it a couple times. Are you thinking it's bombed out enough, Rick?
I'm always early. So I've been buying some sulfide nickel stocks. Guarantee they're going to fall another 20% if I'm getting long. Um, I'm a sucker for sulfide nickels. They've treated me extraordinarily well in my life. They're rare beasts. I think maybe you guys talked to me last time after I flew back over the lateritic nickel fields in southern Sulawesi.
Yeah.
That's a disgusting sight. It's a truly disgusting sight. And I don't know how much longer the Indonesian government or the Indonesian people will put up with that. And to the extent that the operators are forced to exercise normal constraints with regards to the environment, the cost advantage enjoyed by lateritic nickels changes very, very, very rapidly. The same comment with regards to rare earths, by the way. They're not rare. We haven't looked for rare earths because the Chinese have produced them so cheaply. What a lot of people don't note is that environmental standards in Western China are advancing very rapidly. And the environmental destruction that the Chinese allowed and were willing to endure in Xinjiang are a thing of the past. One of the things that they don't talk about so much is that the cost of producing rare earths in China is going up very quickly. And that would suggest that the economic incentive price for the rest of the world doesn't suffer as much from the Chinese advantage as the market thinks it does. The same way in nickels that I think the price advantage enjoyed by the Indonesian laterites begins to dissipate as they're forced to adapt Western world environmental standards, or if energy prices go up. That process is extremely energy dependent.
Mm. Another commodity just on the wrap up, Rick. Silver. Silver's had a great run, and
Yeah.
I suspect you might think the early money's been made there.
Yeah, silver is an enigma to me. It's treated me very well. You confuse yourself thinking about it as an industrial metal, which of course it is, but the price moves they all coincide with precious metals bull markets. I don't know why it is, but I know that it is true that precious metals bull markets begin with the fear buyer. They begin with gold, in effect, gold bullion. And as the advance in the gold bullion price goes faster than the cost of producing gold, the gold company margins start to go. And leadership in the precious metals bull market goes from physical gold to the best of the best gold producers, which is what we've seen this year. Then it goes to the best of the rest. The money moves down the quality trail. At some point in time, increasing free cash flows and the momentum of the sector itself validates the precious metals narrative to the generalist investor. And when the generalist investor comes into the resource space, I don't know why. I suspect because of the lower unit value. Silver goes crazy. I mean, absolutely crazy. I've watched it happen 3 times in the past. And by the way, when that happens, you won't need Rick Rule to tell you it happened. People who haven't lived through that bull market drives themselves just literally crazy with a move from, I don't know, $31 to $33.75 or something like that. We will see in this bull market that kind of move on a daily basis, happening several days in a row.
Silver's such a fantastic one because there's just not that many great ways to play it here on the ASX and in Australia more broadly. So it's kind of forgotten about a little bit, but I get from the
No. There's silver bugs out there. You just
No,
got to interact with them.
they're out there. Just the ways of playing it in Australia are finer, whereas throughout the Americas you have the deposits and the companies in much more abundance.
You all were spoiled. You had Broken Hill, which was one of the greatest silver mines in the world in drag, and then you had Cannington. So although you haven't had a lot of starts, you had a lot of finishes, or at least a couple spectacular finishes. It's very difficult to duplicate those successes. I think that to the extent that the punter community in Australia begins to reward the silver narrative, the Australian geo probably will do pretty good work in the American Cordillera. I'm not sure how many primary silver deposits Australia itself will yield. But I note that the Australian investor is becoming much less ethnocentric than he or she used to be. It used to be one of the best ways in the world for a foreign investor to get value was to buy a non-Australian asset in an Australian company during an Australian bear market, where you guys, I mean, you guys even viewed the New Zealanders as wogs, you know? Uh,
Yeah.
that day is, from my point of view, sadly over.
One more commodity that I've got to ask you about, Rick, tin.
I'm attracted to the tin business. Again, it's very difficult to play it. Easily the best tin name in the world is Alphamin. Unfortunately, it's located in the worst part of one of the worst countries on the planet. That's been a challenge, but I'm quite attracted to tin. Tin is one of those unheralded high-tech minerals. You don't have microcircuitry without tin, period, full stop. And the whole world is microcircuitry.
You've explained a sort of similar narrative in the PGM space, and you've played it through the physical. Would you do the same here?
The problem with tin in terms of the physical, I looked at it a long time ago when I was with Sprott, because we looked at the success that we enjoyed with the physical uranium trust and said, where can we do this again? What happens with materials like tin and nickel and copper is that the price to move it and the price to store it relative to the price of the commodity is a bit too low. It's something that might work as an example for me personally as a speculator, buy a bunch of tin in some warehouse, Kuala Lumpur or something like that, and leave it there. Do something smart, nothing. But in terms of making it a financial product, the relationship between storage cost, shipping cost, and the price of the commodity itself means that the overhead around running the physical trust makes it less attractive to the investor base than, say, platinum and palladium or gold or even silver. I should tell you an anecdote. At Sprott, we owned on behalf of investors a lot of gold, billions of dollars worth of gold. And I was, as a consequence of that, allowed into the Royal Canadian Mint to see this gold. And I have to tell you that the pile of gold that constitutes a few $billion is distressingly small. It's really unimpressive. After my disappointment, I was ushered into the room where our silver was. That was much better. Much more satisfying. It looked like billions of dollars worth of stuff. I tell you that partially to amuse you, but partially to say that I'm skeptical about the efficacy of investment products, physical investment products, around commodities where the price relative to scale isn't good.
I've got last one for you. You always get asked what your contrarian views are, and you are a contrarian through and through. That's your identity. So what's your most consensus view in commodity markets and the mining sector right now?
I'm afraid I'm great. I've grown to accept the most crowded trade, which is the anti-US dollar trade. And I sort of believe the US dollar is probably overhated in the near term. As an investment theme for a decade, I think it's still very much intact. Our political class seems to do a wonderful job of promoting the anti-dollar. Every time I watch our political leadership, I feel more comfortable with the anti-dollar trade. I remember, however, and my friend Joel Lippman reminds me of this at our conference, the famous quote that the US dollar is the worst currency in the world with the sole exception of all of the others. And while I feel bad about the US dollar in isolation, I feel less bad about it relative to other currencies. All of that by way of saying it wouldn't surprise me to see gold take a breather if the US Federal Reserve doesn't whack US interest rates. If they whack US interest rates, that'll show the world savers that any concern for the legitimacy of the US dollar is a thing of the past in US society. If they don't cut interest rates, I suspect that the dollar price run in the very near term, I would define very near term as less than a year, is overdone. I literally am pained to say that I believe that the political and social reality of the United States is such that the US dollar in absolute terms, not relative to the Australian dollar or other currencies, but rather in absolute terms, will lose 75% of its purchasing power in the next 10 years. I lived through that before. In the decade of the 1970s, according to the Office of Management and Budget, the US dollar lost 75% of its purchasing power in 10 years. That was a character builder, and I'm already a character. It wouldn't surprise me. One must remember in the decade of the 70s, when the US dollar lost 75% of its purchasing power, that the gold price increased 30-fold. I'm not suggesting that the gold price is going to go up 30-fold. It's already up 12-fold since 2000. But it wouldn't surprise me at all to see the nominal gold price in US dollar terms mirror the decline in purchasing power of the US dollar, which would suggest a 3 or 4-fold expansion in 10 years. So overbought now, a commodity of necessity over a decade.
Fantastic, Rick. The parallels to the 70s are a super interesting one, which we've sort of stewed over a few times in the past, but I think they're endlessly sort of fascinating, and you can talk about them at length. But
Despite not living through the 70s like yourself.
have to have that experience for ourselves. Thanks again for making the time and coming on Money of Mine, Rick. As always, it's great to chat.
Always a pleasure. I look forward to visiting with the Australian audience. I look forward next year to coming down, looking around, speaking at a couple of conferences. I look forward to being down there. I've been gone too long.
And there we go, mate. Plenty of contrarian wisdom sprinkled in there throughout. A massive thank you to our fantastic partners for making it all happen. Sandvik Round Support, Focus, the platform by Market Tech, Axes Mineral Services, and last but not least, get your tickets to Africa Down Under next week.
Hooroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.